Uh, Good afternoon. In fact, we are continuing the lecture that we started last week. That is risk and term structure of interest rates. And you probably already have an understanding in terms of what is this risk structure that we are talking in this section. The risk structure that we were referring is when it comes to financial assets, we take here the bonds. We take bonds with same maturity, but they have different interest rates, right? So this difference in interest rates arise from the three factors that we started looking at. One is default risk, second one is liquidity, third point is tax consideration. So we have the same asset class, that is, let's say, bonds here, and also the same time to maturity, let's say 5 years here. But you probably see here the interest rates applicable to these same bonds differs in the form of its default possibilities or the default probabilities, and you can see the liquidity considerations, and also from the perspective of tax consideration applicable. So then you differentiate this, and then we have come to the point to define what is this default risk is. And we recognize the default risk in the form of probability that the issuer of a bond is unable or unwilling to honor his obligations. That means in the case of bonds, it's a timely payment of coupons and the maturity at maturity date. So if he does not have the willingness or he is unable, that becomes the default probability of these bonds that we are looking at. And interestingly, this default probability that we are looking at a financial asset, specifically the bonds, being widely and respectfully analyzed by a rating process, credit rating process. And we have really gone through the rating process applicable in this process. And we have broadly recognized the rating by three leading rating agencies in the world. That is nothing but the Fitch, Moody's, and S&P. Okay, Moody's, S&P is Standard and Poor's, and then Fitch. So they have rating scales, and we recognize that within this rating scale, you have so-called prime grade, that is most safest investment in the form of AAA rated instruments. And then you can see investment grade, and then coming down the ladder, you probably see the probability of defaultness increases. That means non-investment grade categories coming, and ultimately we see so-called junk bonds, right? Like junk foods that we are used to. So you can see that the bonds also classified in the form of so-called the default probabilities, and they have listed down this information. That's where we have stopped our discussion last week, and I'm continuing from that point now. And if you have any question, please feel free to drop me a message. I can see it in the screen here, so I can follow up as we discuss some of these concepts. So we are here, the same handouts that we have used last week, and I have taken you up to the point where we discuss all these rating processes. And to detail little more, okay, so this rating is an evaluation of the timely payment, okay, timely payment, ability of interest, and capital of an individual for more debt security as a bond that we discussed just now. So this bond rating evaluate the timeliness of payment probabilities, both capital at maturity and also the interest during the lifetime of a financial assets. In the case of bond, this is the coupon payment. Okay, this could be for an individual, this could be for a firm, or for a debt security. That means if it is government of Sri Lanka, in the analysis, it's the government of Sri Lanka is the a responsibility. But then within the government of Sri Lanka, you probably see number of bonds issued at different time. So that's why they say debt security. So one debt security against the other. So they all recognize these things by that debt securities special identification number, right? That is called ISIN, International Securities Identification Number. We referred in one of our previous lectures. So this bond rating evaluate the probability that these aspects, principal at maturity and during the lifetime of the bond, the periodic interest payments, and these aspects also required to be paid timely. Let's say if it is required today to be settled, no point of settling it the next day. So that it refers to a default in the aspects of rating analysis and in the eyes of investors. So what you are basically looking at here is timeliness of settlement of obligation. But please understand, when I say today, usually in financial markets, holiday treatments are there. If it is Saturday, often next business day is the due date. If it is a business day, the weekday or a business day, you have obligation as it is. So when it comes to bond, usual settlement in a financial market is the next business day. But in the case of treasury bills, the previous, that means if it is today, that means you have to settle yesterday, that means Friday. So that's a kind of a convention, but this convention could be changed in the form of written documents goes with the bonds or financial assets. These are known as offering circulars, OCs of financial assets. So that details out all the details. You can go to Central Bank of Sri Lanka website. The very recent Sri Lanka Development Bond, SLDB issuance, you can go to the website and see the offer circular of the SLDB. That details out everything that I'm discussing here in the form of timely payment, how the payment being made, how the holiday treatment is there. Please kind of, keep an eye on these things. When I say some references, you should be trying to kind of access it, because that would give you much more clarity in terms of what we are discussing here, what we are applying in the course throughout. So when it comes to bond rating, you probably see this element being looked at by bond or these rating agencies, and these rating agencies build on their rating. They built this bond rating on the basis of three aspects. One is its credit history, right? Then next is the present or the current financial position of the issuer or the institution or individual in this case, or the future income, likely future income. So your prospects of having a reasonable return and your ability to honor your future obligation. So these three aspects are very, very important element which drives the level of rating applicable to a particular issuer or particular issuer's issue, debt security I was referring here, right? So these rating agencies look at this. For instance, in the case of Sri Lanka, you see the credit history is very creditworthy. We never defaulted at any time in our history. That really matters. But there are some countries, especially in Latin America, they have history of number of times defaulted their obligations, right? So this matters, right? It's like when it comes to analyzing an individual, his background, okay, his past history, and even if you apply for a loan from a bank, what the bank does is they check with the so-called CRIB, Credit Information Bureau, of your credit history, whether you have a good track record or whether you have already kind of defaulted your previous obligations. And in the case of these analysis, the advanced economies has much more broader spectrum. It's not only the credit analysis that they do here, but also your utility record. You have motor vehicles being purchased, whether you have honored your timely payments, whether your utility bills, including telephone, right? Whether you have honored, whether you have paid pay TV channels and things like that, whether you have honored, it's a wide spectrum. So that itself gives the understanding to the rating agency of your history. So this is a very important element that they look at. And then your present financial position. Of course, the present might be driven by, for instance, the recent COVID, right? So it's a kind of, challenge for most of the institutions. But that does not prevent their future probabilities of income by looking at their historical and also prospective opportunities in the future. But the present circumstance also important, because present decision making probabilities, how consistent in terms of decisions being made by the institution concerned and the leadership, okay, what is the direction and the focus of the organization concerned. These are important for credit rating agencies to look at. And also the credible plans that they propose and related future income streams. For instance, if it is a bank or an insurance agency, or for that matter a firm, how their future inflows being lined up. So whether you have a credible line of income on a continuous basis. And even in the case of government, how they look at your tax structure in the country. Okay, how's your expenditure structure? How's your medium-term fiscal framework? How's your debt payment track? And all these matters. So ultimately, based on this, the rating agencies come out with a conclusion in the form of a rating scales that we refer. So that one explanation in the form of AAA, triple B, double B minus, double B plus, single B, whatever that you call it, it refers to a certain element of probability involving that particular organization in the form of honoring its liabilities. So the investors all around the world are familiar with such notations, and by looking at that particular arrangement itself, they are comfortable in analyzing this institution's circumstance. Okay, so these credit rating agencies not only does this particular rating and keep silent, no, they continuously collect information, store them, analyze them, and summarize them, and they also sell this information for prospective investors. But on a periodic basis, they make statements, they publish the reports for investors to analyze. So this is a common thing, and you probably see these reports come in and off in press and highlighted in financial media, and you probably see reference to their rating actions and things like that. So this is a very interesting element that you will come across in analyzing most of these financial assets, particularly the bonds that we are referring. So I believe that's very clear, where we stopped last week and then clarifying further on so-called credit rating aspects. So I'm continuing the presentation into the other aspects that's lined up in this section. Any questions that you have, you can just post it in the chat so we can follow up on the basis of what we are discussing now. Okay. Now what we are seeing now in the form of this analysis is the default aspect being looked at in the risk structure. Then the next aspect governs or follows in this line of analysis is the liquidity. Okay, so we are looking at bonds with same maturity but different interest rates levels. So why these differences? One is due to default probabilities that we now discussed. Second is the liquidity. So what this liquidity means, okay, is nothing but the relative ease with which an asset can be converted into cash. So in a very simple sense, what it means is how easily you can convert your asset into the currency or cash form. Okay, that's the liquidity. So most of the financial assets that we are talking here has very good liquidity in the financial markets, and especially bonds and bills These are quite liquid. You can convert them into cash very quickly. But one element when you convert this into cash applicable is the market risk. Market risk is the interest rate structure prevailing at that moment of time. Whether you buy at a high interest rates or low interest rates, what happened here is market interest rates doesn't remain static. Okay, market interest rates are dynamic. And it changes every time. So with the changes in the interest rates, you expose yourself to market risk. So when you buy something at a high interest rates, okay, the probability that interest rates to decline makes you earn capital gains. If you buy something at a lower interest rates, the probability that you lose capital is very high because interest rates could go up. When interest rates goes up, the prices decline. Higher the interest rates, lower the prices. These are very basics that we discussed many times all throughout. Okay, so that is something when you convert the financial assets prior to its maturity, you take the market risk. But that is one element. But what matters here is how easily, how quickly you can convert these assets into currency or cash form. That's what liquidity is. So liquidity comes with so-called cost of selling or cost of converting into currency. Okay, and then of course another element is number of buyers and sellers in a bond market. Wider the investors, okay, bond is more liquid. Why it is? Because when you see a bigger number of participants, the perspectives, different expectations exist. If everything is like very few participants, they all are same type, often they take a same view for all the economic probabilities. So everybody is in selling side, everybody is buying side at one given moment of time. Then there is no market. But when you have a very diverse type of buyers and sellers, that means number of buyers and sellers are large, means the diversity is very high. So when the diversity is very high, the different views, one might think tomorrow the economy would perform better. Some might think it's not. Okay, next week, next month, 3 months from now, 1 year from now, the economic expectations differs. So then some is interested in buying, some is interested in selling. Always there's a market, buyers and sellers there. So that's very easy to convert your asset. Okay, so it's a directional and also very well diverse. So that's why when it comes to a bond, diversity of investors also important, right? So when you see such aspects or characteristics in a bond, you conclude that bond is highly liquid. And another element is cost of selling these bonds. In financial markets, these financial assets are easily tradable. Okay, so these are easily tradable and you have established arrangements. Sometimes you have trading flows like Colombo Stock Exchange when it comes to equities, that is stocks. And also when it comes to bonds in Sri Lanka, you have a trading platform, that is Bloomberg related trading platform, that's been handled by all the market participants. Okay, banks and primary dealers. So anybody wants, they can see the prices. Somebody is ready to sell, somebody is ready to buy. Often this get selected by participants when they want to sell, when they want to buy, and trade gets through the system automatically. So it's very fast. And similarly, throughout the world, there are trading platforms. So that has a reasonable defined cost structure for a transaction in the form of a certain fixed amount or a percentage of transaction value, but often with a cap. Okay, so you see this type of probability. So when the liquidity of a instrument is high, means even this cost structure is very low and very much established in line with market principle. But you probably see there are some assets, including property, it's not that easy to convert into currency or cash. You had to go through a process. You had to go through the kind of a hassle of finding buyers, advertising, and it's kind of, following up many times, or giving that to a kind of a real estate agent to kind of a follow up, right? So that takes time, even used cars. Okay, so there are different type of markets establishing now, but to some extent with the e-trade, e-mode of transactions now getting popular, you'll probably see the markets are also becoming more vibrant in recent times, and you find a diverse segment of participants buying and selling instruments. So that's a good sign, but ultimately this liquidity is also important because that drives the instruments prices or ultimately the interest rates. So what matters here is when the liquidity is high, price of the financial assets is high. That means interest rate is low. Higher the liquidity, higher the price, right? So similarly, higher the default probability, lower the price. That means higher interest rates. That's the first point that we discussed with credit rating and all. So you have seen lower rated bonds have to pay higher interest rates in the market. That's the spread that we analyzed with US Treasury. So when the spread is high, that means high the interest rates. So higher the interest rates mean lower prices. So probability is that in the form of default probability that we analyzed. Higher the default probability has, higher interest rates. Higher liquidity is, lower interest rates. And then income tax consideration. That's another very important element that we are discussing here. So when it comes to income tax consideration, so interest payment on certain type of bonds. In the case of US, they had the municipal bonds. Okay, in Sri Lanka you don't see municipal bonds, but in US municipal bonds are very popular. So municipal bonds are exempted from so-called income tax compilations. So what matters there is a municipal bond become popular among local investors, and as a result, municipal bonds at times the yield is lower, interest rate is lower than US treasuries. Okay, but recently US also brought the arrangements to a kind of a same footing, same status quo. So we don't see municipal bonds are popular, and also with the financial crisis and other related problems, municipal bonds become still popular, but US treasuries become much more popular in US and other global investors. So you see that probabilities. And in the case of Sri Lanka, we had withholding tax some time back for government securities, but that was taken out recently. So here we don't have any withholding tax currently applicable for treasury bills and treasury bonds. So these income tax consideration also makes bond yields to be different. And if there's the income tax applicability, what happens is that bonds become less attractive to a bond that does not have any income tax application. So that's why municipal bonds become popular against US treasuries some time back. But generally, when it comes to markets, they try to kind of now bring in uniformity across financial assets treatment, thereby not letting this tax consideration distort pricing structures. But then the tax consideration can be applicable through income, where income is taken into consideration all your return coming from financial assets investment and things like that. That's a different compilation arrangement. But what matters in this analysis is when you look at risk structure, now you know default analysis, now you know liquidity analysis, now you know tax consideration. So because of these three elements, even though the maturity or the time to maturity is same of a bond or financial assets, its interest rates could be different. Okay, so in this exercise, it's very important that you are recognizing these elements and try to interpret why that maturity, okay, that we are looking at 5-year or 10-year that we are seeing, but these interest rates differ from one type of bond to the other. Why corporate bonds are higher in interest rates to government bonds? Simply because default probability of government bonds is lower in a general analysis. simply because liquidity of a government bond is very high in a general analysis. Okay, so these are the things that is very important for you to understand in this section, for you to differentiate why bonds are different in interest rates although their maturity is same. Okay, so we were discussing about this municipal bonds and treasury bonds in the case of US. So you see this charts here, bond supply and bond demand charts. In the left chart, you are seeing the market for municipal bonds, and in the right chart, you are seeing market for treasury bonds. So what you are simply seeing here is tax-free status given to municipal bonds. Okay, so when the municipal bonds become tax-free, so you can see here municipal bond demand M that you are seeing in the chart in your screen, left chart in the screen. So it gets shifted to the right. Okay, so as a result, demand for municipal bond increases. When the demand increases, when there's no change to the supply, you see the prices increase. That's why PM2 from PM1. So when you see the price of municipal bond increase, what it indirectly means is the interest rates of municipal bonds decrease. Okay, higher the price, lower the interest rates. So you see that element here, and then you can immediately see a similar corresponding reflection of market shift in municipal bond is reflective in the chart to the right in the screen, that is ST, that is a supply of treasury, US treasury bond. So the demand DT is shifting to the left. So lower demand for municipal compared to municipal bonds. Now the treasury bonds has lower demand. So when the supply is same, what you can see here is the price of treasury bonds is declining, PT2. So when the price is declining, meaning interest rates are increasing. Lower the price, higher the interest rates. Remember that, right? So this is the element that we were discussing in the form of tax consideration. But as said, now there is no differentiation as far as the tax treatment are concerned for municipal bond versus treasury bonds in the US. But what they try to apply is they try to apply in the form of overall income tax analysis, where income from whatever investments being considered in compiling final taxes by investors or the individuals in the US. So these were the kind of drivers: default, liquidity, and tax consideration. So we can move on. We can move on to the next important, very, very important aspect of this segment of study. That is term structure of interest rates. Term structure of interest rates. Before I move into this, do you have any questions on risk structure of interest rates that we discussed? Please feel free to drop a message if you want to clarify anything on what we discussed in the form of risk structure, and we can move on. And we are now looking at term structure of interest rates. So what you are highlighting, what you are discussing here is, now you bring so-called elements that we discussed in the risk structure: liquidity, okay, default probabilities, that's what identical risk here, and then tax characteristics, okay. But still they have different interest rates. Now you look at same liquidity, same tax treatment, okay, same default probability, but their interest rates are different simply because time to maturity. The maturity is now different. 5-year to 10-year, the interest rate is different. 3-year to 5-year interest rate is different. So previously we kept maturity constant under the risk structure, and we varied default probability, liquidity, and tax characteristics. Here we make default probability, liquidity, and tax characteristics constant, but we vary the maturity. Okay. So bonds with identical risk, liquidity, and tax characteristics may have different interest rates because the time remaining to maturity is different. That is what term structure is explaining. What the risk structure explaining was the bonds with same maturity but different default, liquidity, and tax characteristics makes the yields or the interest rates of those bonds to be different. That's the risk structure. Now term structure, where we are looking at identical risk, liquidity, and tax characteristics, but different remaining time to maturity. Okay, so that makes the interest rates to be different. So we are getting into that area of analysis here. And in this area of analysis, a very, very important sub-concept that you are learning is the yield curve. Okay, so what's the yield curve is a plot or a chart, you can call it in that way, of yields or interest rates on bonds with differing terms to maturity, but same risk, liquidity, tax consideration, term structure of interest rates characteristics. A plot of the yields on bonds with differing terms to maturity. That means the maturity is now variable, but identical risk, liquidity, and tax considerations. So when you present this in the form of a plot or a chart, what you are seeing is a yield curve. So when you take a yield curve analysis, what you are basically bringing to the x-axis is the maturity, time to maturity. 2-year, 5-year, 10-year, 15-year, 20-year, that's in x-axis. Y-axis will remain either price or interest rates. Okay, so when you see the interest rates in y-axis and time to maturity in x-axis of same characteristics bonds, what you are basically seeing is different interest rates simply because time to maturity is different. So if you plot this for a given moment of time or given moment of the given particular date itself, so you can see either this could be upward sloping, if not flat, or downward sloping or inverted. Inverted means downward sloping. So upward sloping means longer term rates, that's mean longer time to maturity interest rates are above the shorter term. That means not long but short maturities interest rates are concerned. So what you are basically seeing is short-term interest rates are lower to long-term interest rates in an upward sloping yield curve. So that is like a staircase. What you are basically seeing is the first step, you take it as a short term, the height is lower. The second step, that you take it as second year, right, somewhat higher than the first a step that you see in the staircase. So that is like upward sloping. The first one is lower than the second steps. Likewise, 10th step that you are looking at, right, the height is much higher. Okay, so very much above the first and second step that you are seeing. So that is upward sloping. So the yield curve, where the interest rates are plotted in the y-axis, the maturity is plotted in the x-axis, you will see as the time to maturity expands along the x-axis, right, the yield rates also increases. So you draw an upward sloping yield curve. So this is the upward sloping yield curve that we are analyzing, and you will be seeing normally in all the markets under normal circumstances. But at the same time, you could have a flat yield curve, right? It's like the rooftop as an example, or for that matter, when you connect two staircases, the landing points where the structure is flat. Okay, so you find the interest rates, irrespective of whether it is a short term or a long term, are not different. It's the same. So it's a flat yield curve in comparison to upward sloping that you have now analyzed, now studied. So next is so-called inverted. That means you are coming down in a staircase. You are first looking at the higher step, okay, or the longest maturity in a yield curve sense, right? But unfortunately, in an inverted curve, those long-term rates are lower and short-term rates are higher. So when you are coming down, first step is, if you take as the shortest term, that is very much higher in height in comparison to last step before you reach the land level, right? Where the height is very, very minimal. You're coming down there. So that's the inverted, where the short-term rates are higher than long-term rates. So inverted means downward sloping. So please remember, it's very straightforward, but people confuse. Upward sloping means the long-term rates are greater than short-term rates. Downward sloping or inverted means, right, short-term rates are greater than long-term rates. Flat, that is nothing but short-term, long-term, there is no difference in interest rates. So this yield curve that you see at any given moment of time could have any of these shapes. But normally, what you are simply seeing in all the markets is upward sloping yield curves, because other type of yield curves that we see, flat, inverted, signals possible economic events. Possible economic events. So in US, if they see inverted yield curves, downward sloping yield curves, they presume that they are heading for a recession. They are heading for a recession. That means declining. That means negative economic growth. Recessions are negative economic growth. So they see this as an early indicator of economic prospects economic prospects in a country. So US often see, when they experience an inverted yield curve, that followed with a negative economic growth in US history, right? So what they usually see is, it's not like one-off inverted shape, but a reasonably prolonged, right, for a reasonable duration. If they see that the curve is inverted, the economic event that they're expecting is their growth is going to go into negative territory. So that's a kind of a feature. A flat yield curve is a pre-runner to a possible inversion in the yield structure, right? So you see, these are kind of early indicators, or that is the kind of measure of economic health in the financial markets by looking at these shapes. Okay, so then within this upward sloping, inverted, you probably see steep upward sloping, steep inverted, mild upward sloping, right? That is reasonably flat, but you are simply seeing a mild upward sloping kind of a structure. But interestingly, this has many messages for an economic analyst to analyze. For us to see so-called term structure of interest rates, where we now see identical characteristics of risk, liquidity, and tax arrangement, but you probably see uh, uh, different maturities have different interest rates, and then you plot this into a chart. You call it a yield curve, and these yield curves could be upward sloping, flat, or downward sloping. That has many messages for us to read and interpret. So that's where we are studying these elements. Any questions? Right. So moving on, okay, there are theories now. So this theory of term structure of interest rates explains certain facts. Okay, so theory of the term structure of interest rate needs to explain interest rates on bonds of different maturities move together over time. For instance, if you see short-term interest rates are increasing, what this expects is medium to long-term interest rates also to increase. So when the short-term increases, they expect entire so-called yield curve to go up. Maybe a parallel shift or a different shift, but they expect the direction to be at least, if it is increasing, it is increasing across different maturities. Okay, so that's one expectation of the theory of term structure. So this theory of term structure try to now analyze these elements through three major theories. We'll come to that after this explanation here. So first element that they are looking at is the interest rates of bonds of different maturities needs to move together. And then they look at when the short-term interest rates are low. Please remember, when I say low, it is comparatively low, right? So short-term interest rates are low. They're expecting yield curves to be upward sloping. When the short-term, let's say 1 year interest rates are low, the longer tenor, 5, 10, 15, 20, 30, whatever you call it, they expect those interest rates to be higher. So that's why it is upward sloping. But at the same time, when short-term interest rates are high, okay, so now the scenario is short-term rates are high. They expect the yield curve to be downward sloping, if not inverted. It is very easy. I mean, this is very easy to explain when you build the analysis in terms of the inflation expectation. So when you see short-term, today's short-term rates are high means today what you are trying to do is you are trying to reduce your future inflation. The policy authorities like central banks increasing interest rates today means they are expecting future inflationary possibilities. So they wanted to bring those inflation expectations control or reduce future inflation. So when you reduce future inflation, you know nominal interest rate is a function of real interest rates plus expected inflation. That's the Fisher equation we learned, right? So when you see future inflation is coming down, expected inflation is coming down, when you have a given real rate, real return expectation, your nominal interest rate also has to come down. So today you have a higher interest rates. What it means is your future inflation being targeted by policy authorities, and what you are basically seeing here is your future interest rate structure to be lower. So if anybody buying longer tenor bonds today need not be expecting same high level of interest rates what you are seeing for short term in financial assets today. So short-term interest rates are high and long-term interest rates need to have a lower structure. That means the yield curve that you are looking at should be downward sloping. So that's the second element of theory of term structure. First is the interest rates of different maturities move together over the period of time. Second element is when the short-term interest rates are low, yield curve is expected to be upward sloping. When short-term interest rates are high, yield curve need to be downward sloping. Okay, and third element they try to understand, explain is yield curve almost always try to slope upward. Where now we discussed in the second point, when the short-term interest rates are high, yield curve need to be downward sloping. Okay, so that's one fact that the theory has to explain. But the third point that they are trying to explain is under normal circumstances, yield curve almost always slope upward. And that is also very clear so-called time premium that anybody expects. So you see, when you are an investor, right, you have reasonable certainty of what's going to happen tomorrow, what's going to happen next week. But you are not necessarily that confident to say what's going to happen 1 year from now, 3 years from now. It's difficult. Even when you look at your health, right, you are reasonably sure what's going to happen for you tomorrow. But still uncertainties could happen, but it's reasonably sure. But unknown things happening is greater longer the time from now. So when it comes to yield curves, the longer the duration, that means longer the maturity, the probability of unknown things happening is greater. So then you require so-called a premium, higher premium for longer duration, that is time premium that we are looking at. So higher the duration, longer the maturity, you need to have a higher premium being added to your investment. So it is very natural yield curves to have a upward slope because short-term rates then naturally be lower than longer-term rates. So these elements are the crux or the center of the so-called term structure theory, and we are trying to unearth these things by looking at three theories that explain these three facts. Okay, so term structure theory that you look at now has three elements. First is the rates are interest rates of different maturities move together. When short term increases, you expect medium to long term also to increase. When short term rates to be higher, you expect yield curve to be downward sloping. When short term rates are lower, you expect yield curve to be upward sloping. And also you expect yield curves in most of the time to slope upward. So this is what the term structure theory try to kind of explain. And these explanation that we looked at being analyzed through three theories. These three theories that we are looking at is, first is expectation theory, or one could call it expectation hypothesis, which tries to explain the first two facts, that is the different interest maturities, interest rates move together. And then when the short-term interest rates are low, yield curves are upward sloping. When short-term interest rates are high, yield curves are downward sloping. But it is not explaining the third element, that yield curves are normally upward sloping. Then you have so-called segmented market theory. Okay, that explains the third element, that yield curves are normally upward sloping. And then you have the liquidity premium theory that combines the expectation hypothesis and segmented market theory and brings in all three explanations into the equation. So this is what we are trying to concentrate now, and these areas are quite close to kind of, you know, the engagement in terms of some of the publication I also have published during my postgraduate periods, and you probably see, even if you Google my name, probably you might see some of these publications appearing in peer-reviewed journals. So these were kind of different theories that tries to explain the understanding in terms of why a term structure of interest rates kind of shaped differently. Why term structure of interest rates explains that interest rates move together. Why it explains that under normal circumstances the yield curves are upward sloping. Okay, so all kind of explanations can be find out from these theories that we are looking at: expectation theory or hypothesis that we are using, segmented market theory, and also the liquidity premium theory. And also in between we have a so-called preferred habitat. It is not different to segmented market theory. So that also we bring into the equation to explain these elements that we are going to analyze. Okay, any questions? Okay, so we can see now a chart here. This is not a yield curve. Sometimes it's very unfortunate. So-called economic pundits, sometimes they come and explain this as a yield curve. This is not a yield curve. This is a time series analysis of yield behavior of different type of bonds that you see in the market. Okay, so what you are basically seeing is, if you take a one point of time here, let's say you are taking 2005. If you take 2005 here vertically, if you draw a line vertically here, right, these are all same US treasuries, okay, but different maturities. So when it comes to same US treasuries, you know, term structure of interest rate explanation, identical risk, identical liquidity, identical tax consideration. But what differs here is the maturity, time to maturity. So if you take a point here, 2005, as I said, if you draw a vertical line, but precisely for that particular day, or even within the day, that particular time, you can find out and draw a yield curve. So you can draw this green line, that is 3-month bills, and 3 to 5 year average of blue line, and 20-year bond average of red line. You can dot them across the x-axis where 3 months, 5 year, 3 to 5 year, and 20 year, and you can dot them. So then it is the x-axis different maturities, and then y-axis interest rates. So you can see whether it's upward sloping, downward sloping, or a flat. To me, this 2005 appears to be upward sloping. Here the green is at the bottom. That means interest rates are lower. That means 3-month interest rate is lower than the blue, that is 3 to 5 year average, and similarly lower than 20-year bond, that is much higher than these two maturities. So what you are basically seeing an upward sloping yield curve. But similarly, if you go and draw a line, vertical line across, let's say early 1980s, let's assume 1982 here, you find short term, that is green, is at the top. That means short term interest rates are higher than blue, that is 3 to 5 year, and that blue also higher than 20 year, that is red. So what it indicates is short term interest rates are greater than longer term interest rates. So it is a downward sloping yield curve, and it is fair enough. In early 1980s, US had high inflation driven by high oil prices. And then US policymakers, Federal Reserve, US Central Bank, increased its short-term interest rates to fight inflation, as I was explaining to you when I mentioned about the downward sloping yield curves. Right? So that's a one possibility. But at the same time, there are points here where all these interest rates are on each other, no different. They are almost same. Okay, so like 1960, prior to 1960 period, where 1958 probability that everything is on each other. And also similar point that we can see somewhere in late 1960s, and even during 1980-85 horizon, there are some points where all interest rates are on each other. Okay, so it's a flat yield curve. So these are all probabilities. If you look at a time series analysis like this, but this is not a yield curve, as I said. But if you take a portion of this, vertical portion of this, at one particular date of a particular year, but interestingly, even within that date, you have to take a particular time and see where the rates for different maturities in the x-axis, and then you join those rates, you can draw a yield curve. So this is government papers, US Treasury papers. Identical risk, identical liquidity, identical tax consideration, but different interest rates due to different maturities. So that's what term structure is. So this chart very clearly explained to you everything that we will come across: upward sloping, flat, downward sloping, all kind of things of a yield curve, and try to kind of explain through the theory of term structures, facts, by analyzing three theories, that is expectation hypothesis, segmented market hypothesis, and liquidity premium hypothesis. Any questions? Okay, so moving on, what is this expectations theory? It is very straightforward. What it says is the interest rate on a long-term bond will equal an average of the short-term interest rate that people expect to occur over the life of that long-term bond. interest rate of a long-term bond will equal an average of the short-term interest rates that people expect to occur over the life of a long-term bond. What it's very simply say is, if you know you wanted to have an investment of 5-year bond, let's say 5-year bond, that 5-year bonds interest rates that you are seeing today in the market is nothing but the average of, let's say, 1-year interest rates of 5 years that you are seeing during the lifetime of the 5-year investments that you are making. So what it entails there is the 1-year interest rate of first year, 1-year interest rate of second year, 1-year interest rates of third year, 1-year interest rate of fourth year, and the 1-year interest rates of fifth year. If you take all these things and average it out, dividing by 5 should be equal to today's 5-year interest rates. I hope it's clear. What it says, expectation hypothesis, what it says here is the long-term interest rates are nothing but the average of short-term interest rates that occur across the lifetime of the long-term interest rates that you are looking at. So if you are looking at a long-term assets like a bond, that bond's interest rates today is no different to short-term bond interest rates across the lifetime of that bond. Okay, so we will come to the examples, then it will become much more clearer. What it says is buyers of bonds do not prefer bonds of one maturity over the other. Here, what they basically bringing is there is no preference of one maturity to the other. Okay, they will not hold, the investors will not hold any quantity of a bond if its expected return is less than that of another bond with a different maturity, because it's losing their investment's return. If you see expected return of a 3-year is lower to match with the return of a 5-year, everybody will move to the 5-year, not by 3-year. But because everybody is moving to the 5-year, the demand for 5-year bond is increasing. When the demand shift to the right, what happened to the price? Price increases. That means interest rates decreases. So the 5-year interest rates also become equal to the expected 3-year that you are seeing in the market. So that's what it says. So buyers do not prefer bond one maturity or the other, and they will not hold any quantity of a bond if its expected return, in this case 3-year, is less than that of another bond with a different maturity. In this explanation I said 5-year, so everybody moved to the 5-year. So when everybody tries to buy 5-year, naturally demand for 5-year expands. When the demand expands, you know the curve shifts to the right. When the curve shifts to the right, there's no change to the supply, the price increases. When the price increases, it's nothing but interest rates decreases. So that match the market arbitrage available, and that takes out the arbitrage from the equation, and then becomes 3 years expected return would match with 5-year return that you are seeing in the market. So then the investor is indifferent to buying 5-year versus 3-year. So bondholders considers bonds with different maturities to be perfect substitutes under the expectation theory. So what drives the expectation theory is you do not see 1 year versus 10-year different, because you expect across the 10-year, the next 9 1-year interest rates that you come across would equate the today's 10-year interest rates, because it's the average of these 1 years that you are going to get. Is that clear? Right. You can see this example. It is very straightforward. Let's assume the current interest rate on 1-year bond to be 6%. Okay. So what you are basically now seeing is today's 1-year interest rate is 6%. And the investors expect interest rates on a 1-year bond to be 8% next year. So it is first year it is 6% now, 1-year interest rate, but you are expecting 1-year interest rate 1 year from now, that means next year, to be 8%. So when you see 6% of 1-year interest rates today and a 1-year interest rate of 8% next year, the today's 2-year interest rate should be the average of 1-year interest rates that you are looking at across the lifetime of the 2-year that you are looking for investments. So what's a 2-year interest rate in this case is 6 plus 8 divided by 2. So it is nothing but 7%. So interest rate on a 2-year bond must be 7% for you to buy that 2-year bond today. If you see that interest rate for 2-year today is not 7%, but it's below, you would not buy the 2-year. Instead, you will buy 1 year, and thereby 1-year interest rate that you are seeing 6% would further come down because of the demand shift, right? So as a result, what happens there is naturally, for instance, let's assume everybody who wants to buy 2-year, now seeing 2-year interest rate is, right, not 7 but 6.5. So they prefer to buy 1 year today itself. So they move to the 1 year, and 1 year interest rates become 5 because everybody is buying it. So when the 1 year interest rate become 5 and the next year's 1 year interest rate still expected to be 8, so 5 plus 8 divided by 2 is 6.5. That is same as the 2-year interest rates that you are seeing in the market. So then what happens there is the investors become indifferent. The 1 year and 2 year become perfect substitutes. So this is what expectation theory explains. In very simple sense, the long-term interest rates are nothing but the average of short-term interest rates that occur during the lifetime of long-term interest rates that you are looking at. So that is very simply the expectations theory. Okay, so move on. Now we can build the equation. You don't need to worry too much about this equation, but it's very important to understand. Okay, you see this explanation is then built into an equation, and this investment of $1. So what you are basically seeing is IT, that is today's interest rates on one period. Today's interest rates of one period. In the previous slide, you saw it as 6%. And then I expected T plus 1, i.e. T plus 1. That is interest rates on one period bond expected for the next period. That means 1 year interest rates in the next year. T plus 1. That is 8%. That is the 8% in the previous slide. And I2T, that is today's interest rates on the 2-period bond. That's what we derived by dividing IT plus IE T plus 1 by 2 and derived 7% in the previous slide. So that is today's 2-year interest rate. So IT is today's 1-year interest rate. IET plus 1 is the 1-year interest rate 1 year from now. And I2T is today's 2-year interest rate. So this is generally the explanation for you to understand a building of the equation easily. And what we are looking at here is expected return over the 2-period from investing $1 in the 2-period bond and holding it for the lifetime. You don't sell, because I said when you try to sell, you are exposed into market risk. No. So you are basically trying to hold it. So 2-period bond and holding it for the 2-period. So you know the return is nothing but 1 plus I2T, that's for the first year, that is 2-period return, times 1 plus I2T, that is also the 2-period bond that you are looking at for the next period, because you are holding it for the both periods. That means 2 years means 2 years. If it is 3 years, that should be 3 periods. And minus 1. So this equation, you simplify. 1 times 1 is 1. There's no difference. 1 times I2T is 1 I2T. Again, I2T times 1 is 1 I2T. So if you add those two, 2 I2T. Okay. So then you multiply I2T by I2T. So that is I2T square minus 1. So this is very easy if you all are here, and I should be able to write it on the screen for you to understand. But you can easily see this is nothing but expanding the equation, simplifying the equation by multiplying with each other. So when you add these things together, so 1 plus 1 and minus 1 set off. So what you are left with is 2I 2T 2 times 2-year interest rates plus IT2 to power 2. That is like the equations multiplication. So if you investing in a interest for 1 year investment, you basically seeing is if it is 10% interest rate, okay, so this year you get 10%, next year you get 10%. But when you go to next year, if you have not taken out money, you are keeping everything there. So interest computation comes with not your 100 rupee investment, 100 rupee plus your interest income, 10%, that is 10 rupees. So next year what you are looking at is 110 at 10% for the next year return. So it is 11 rupees. So that's why this I2T to power 2 works out instead of only the 10% interest rates that's referred in the explanation that I am making. Since I2T square 2 is very small in the expectation hypothesis, they take that as silent and they conclude the expected return for holding 2-period bond for 2 period is nothing but 2 times I2T. So that 1 rupee, additional 1 rupee return that they are looking at, they look at it as very small. So this itself what drives the liquidity premium theory to explain upward sloping structure when we come to that explanation. So expectation hypothesis very simply says, right? So the expected return of holding a 2-period bond for 2 period is nothing but 2 times the interest rates of 2-period bond that you are looking at. Okay, so interest rates are often explained as a per annum rates. So 2 times of the per annums, that is the 2 period that you are holding, is the interest income expected return of this investment. So similarly, that is 2 period bond that we looked at. If you look at a 1 period bonds, okay, for the 2-year investments for 2 periods, what you are basically seeing is I plus 1 plus IT is the today's 1 period interest rate. So then what you are simply seeing is 1 plus IET plus 1 is 1 period interest rate, expected 1 period interest rate 1 year from now, minus 1. So simplifying this as the same in the previous slide, plus 1 and minus 1 set off. So you ended up with, okay, IT plus I expected T plus 1, that is the next period's 1 year interest rates, plus IT times I expected, that is next year's 1 period bonds return. So the again what they are basically looking at here is so-called this element, IT 1 year interest rates today times 1 year interest rate expected next year T plus 1 as extremely small. So they basically simply they come out with IT plus I expected T plus 1 as the return for 2 periods of holding 1 period bonds. So this being brought into the equation where you have basically arrived at this part in the 2 year bond that we looked at, and then the 1 period invested for 2 periods here in the previous slide. So basically you are bringing these 2 to divide this equation. You ended up with the 2 period rate must equal the average of 2 1 period rates. This is the average, that's why 2 is here. 1 period today, 1 period tomorrow, or this is 1 period 1 year, this is expected 1 year in the next year. Okay, so 1 year today, this you can take it as tomorrow for easy understanding. Okay, so for longer maturities, the same equation instead of 2, now we looked at 2 years, you expand it to say n periods, irrespective of whether 2, 3, 4 or 10 or 30. You can just bring in INT, interest rate of n period bonds is nothing but 1 period interest rates occurs across the n period lifetime divided by n number of years. The same equation expanded to number of years is n here. So you can basically put that n into the equation and derive. So the n period interest rate equals the average of 1 period interest rate expected to occur over the n period life of a bond. So if you take, let's say 3 period, first 1 period is 6, second 1 period is 8, third 1 period is 10. This is an example. Huh? So what you are basically seeing here is 6, 8 and 10. 6 plus 8 is 14, plus 10 is 24, divided by 3. But the answer is 8. So any investor who wants to invest 1 period bonds for 3 years is indifferent if today's 3-year interest rate is 3 period interest rate is 8. So if the interest rate is different to that, either they will move to the 1 period and reduce the 1 period today and equate the interest rate, or if the 3 period bond, that's 8% I was mentioning, is higher, means everybody move to the 8th year, thereby bring down the 3-year interest rate and thereby adjusting the expected interest rates for the future 1 periods in the equation. So this is how expectation theory drives that the investors are indifferent for maturities, and maturity of one period is perfect substitutable to the another period in this equation. So very simple sense, what you are trying to understand here is, right, the long term interest rates are nothing but the average of short term interest rates that occur across the long term that you are trying to invest. So very simple sense, 1 year interest rates today is 6%, 1 year interest rates next year is 8%, and today's 2 year interest rate should be 6 plus 8 divided by 2, that should be equal to 7. If it is not 7, or if it is different, higher or lower, what makes the adjustment is people move from investing 1 periods to 2 period, or they move out from 2 period to 1 period and thereby adjust the interest rate structure in the market, through which the markets become indifferent across different maturities. Okay, and then you would see the explanation of this expectation theory as we have now seen, and it's explained why the term structure of interest rates changes at different times. It's very clear now why it changes, because when you see an opportunity in the other maturity, people move from this maturity to the other, so then the interest rates changes to make that the maturities are indifferent. Okay, and then explains why interest rates on bonds with different maturities move together. Right, so when one side is increasing, it's naturally push other sides, other maturities also to increase, because they wanted to maintain the indifference between different maturities, either by moving out or moving in. Okay, so as I said, it should not necessarily be by same magnitude, but at least in the same direction. If it is increasing, it's increasing, because you don't necessarily see when the 1 year interest rate increased by 2%, the 3 year or 5 year interest rate also increases by 2%. It can happen, but not necessarily, because then the short term interest rates, that means 1 year interest rates that could occur across 5 year period, all will adjust in a different magnitudes to make that the investment of 1 period versus 5 period is no different. Okay, and it's also explained why the yield curves tend to slope up when short term rates are low and slope down when short term rates are high. It's very clear when you see 2 year period interest rates being looked at, right? So when the short term first period rates going up means it's tend to be downward sloping to make this 2 period today investments interest rates to be lower. If 1 period interest rates to be low today, it would make the longer tenor interest rates to be higher. That means it's upward sloping, but it's still difficult to explain. It's usually slope upward, and this is why I said that we keep out that element, because it is too small in the equation, has some explanation here, but expectation hypothesis has not taken that into equation. I was mentioning to you in some of the papers that I was referring, that I have published, and it's available if you Google it. So I'm trying to kind of bring this so-called upward slope element into the equation and try to show, yes, if you take that into the consideration, the third point also can be explained in the expectation theory, but unfortunately expectation theory has not taken that into the consideration. Okay, so that's mainly about expectation theory. Before I move to the second theory of explaining term structure of interest rates, 3 facts. If you have any question, please highlight it so I can then take you through again through explanation in the discussion itself. Okay. So now you are seeing so-called segmented market. Markets are segmented. Here, this makes that the bonds of different maturities are not substitutes. In the expectation theory, what they said is perfect substitutes. They are indifferent to pick one maturity versus the other. But segmented market says the markets are segmented. That means compartmentalized. Okay, one segment is there, another segment is there. So they are indifferent to they are different to maturities of investments. In the expectation hypothesis, they are indifferent. Here they are different. So for them, maturities are not substitutes. Some maturities they prefer, some maturities they don't prefer. Okay. So what the segmented market try to say is the interest rate for each bond with different maturity is determined by the demand and supply forces in that bond market. If it is a short-term bond, demand and supply for short-term bond will determine short-term interest rate, whereas demand and supply of the long-term bond would determine the long-term bonds interest rate. So these markets are not substitutes, and to say that, right, different maturity preference classes are there in the market. And it seems reasonable because we also know, right, pension funds, insurance funds, and long-term saving funds prefer long-term investments. So they often play not necessarily in the short-term or short tenor bond market, but they often are the main participants in the long-term or the medium-term bond markets. They fight with each other in determining what the market interest rate is. But at the same time, you're probably familiar with money market funds, sometimes the commercial banks, short-term liquidity that they carry with them, are the main players in the short-term bond market. So they play and determine what's the market determined interest rates in the short-term bond market. So it is very clear from empirical and what you come across in the market participants' behavior, right? There are different market players, and these market players are preferred in their kind of compartmentalized segment of market maturities they invest. Okay. So naturally, investors have preference for bonds of one maturity or the other because they have their preferences. So they prefer that type of maturity because that matches with their liability structure also. The pension funds, insurance funds, long-term saving funds, fixed deposit and things like that. So they have their liabilities which are reasonably longer term. So they like to match that liability with the asset of a long-term maturity. So they prefer long-term bonds. Whereas money market funds, their liability structure is very short-term. Sometimes it's overnight. Sometimes intraday, within the day itself. So not even today to tomorrow, no. Morning to afternoon. It's like within the day, intra. Okay. So these money market funds, commercial banks, sometimes their liabilities are short term. So they prefer short term. So what it simply says is, if investors generally prefer bond with shorter maturities, simply because I was mentioning so-called uncertainty given longer the duration, okay, that have less interest rate risk. Okay, so majority of the investors are in the short term market, and then this explain why yield curves usually slope upward. In the segmented market, yes, market participants are segmented. They have their preferred compartmentalized maturity preferences. But majority of them prefers short term because it's less interest rate risk, because time is shorter. If the time is longer, uncertainty is greater. I was explaining to you all. So when the uncertainty is less in the short term, bigger participants are there. So that means bigger demand is there in the short term. So when the demand is high, you know the price is high for that market segment, and that determine a lower interest rate. So when the short-term interest rates are lower because higher market participants in that market segment and higher demand in that market segment, you can explain that the demand in the short term drives the interest rates to be lower, and as a result, yield curves are upward sloping. That's the third point of the term structure theory that was trying to explain. Right? So segmented market theory is very clear in bringing down the explanation that the markets are segmented. Majority of the participants are in the short term market. As a result, short term has a higher demand because it's less risky. The time duration is short means some certainty compared to longer duration maturities where the uncertainty is high, greater. So when you see uncertainty is greater, right? So they naturally kind of tend to move out from that market to the short term where the uncertainty is less. So as a result, interest rates in the short term is lower. Low short term interest rates means high long term interest rates. So if you plot this in a yield curve, what you are basically seeing is upward sloping yield curves. This is the normal pattern of yield curve. So segmented market theory is very clear to explain that the market yield curves are generally upward sloping. Okay, any questions? Right, so we move to the so-called liquidity premium and preferred habitat. In fact, so-called preferred habitat is, you know what is habitat is? Your living environment, right? So the preferred habitat again tries to kind of, explain the a segmented market that you are trying to kind of bring into the equation here. But liquidity premium covers that. Okay, so what it basically says in the sense of liquidity premium is the interest rate on a long-term bond will equal an average of short-term interest rate expected to occur over the life of the long-term bond. Please remember this segment. The interest rate on a long-term bond will equal an average of short-term interest rate expected to occur over the life of the long-term bond. When I read this, it should naturally come to your mind that this is the explanation of expectation hypothesis theory. Okay, so it is basically looking at expectation hypothesis here. So expectation hypothesis explain fact 1, fact 2 of theory of term structure, and then plus Please remember, plus liquidity premium that the response to supply and demand condition for that bond, plus a liquidity premium that responds to supply and demand condition for that bond. So effectively, this brings in the segmented market condition where the market is liquid when the bond holders are larger in number. When I was explaining the liquidity under the risk structure of interest rate, I explained to you all number of participants. If the number of participants are greater, higher, I was trying to establish the condition that explains the liquidity is higher. So when the number of participants are higher in that market, naturally it has higher liquidity. Towards longer term maturities, you probably see in comparison to short term maturity, market demand is less. We established that in the segmented market theory explanation. So now you combine the expectation hypothesis component and segmented market hypothesis to conclude that the liquidity premium explains that the interest rates on a long-term bond will equal an average of short-term interest rates expected to occur over the life of the long-term bond plus a liquidity premium that responds to supply and demand conditions of the bond. So these demand conditions that we are looking at is the segmented explanation. So here, bonds of different maturities are partial substitutes. In the expectation hypothesis, they said it's perfect substitutes. In the segmented market hypothesis, it said no substitutes. But liquidity premium says it is partial. Yes, you can substitute it, but then you have to have a adjustment to the liquidity in the market, liquidity premium. So preferred habitat, I will explain that this in very clear sense as we move on. But what you have to understand here is the markets that we are looking at has the perfect substitutability, no substitutability, and partial substitutability depends on the market condition in which it's operate. So that's why liquidity premium brings in the first part of this equation that we discussed for expectation hypothesis, end period interest rates of end period bond is nothing but the single periods that occur across the end period over number of years. This is the average expectation hypothesis equation, except this component including this plus mark. So the liquidity premium very clear to say that it is nothing new but the expectation theories argument plus so-called LNT, that is the liquidity premium for end period bond at time t. Okay, remember that LNT is always positive simply because LNT rises with the time to maturity. Because if you see a liquidity premium that you have to bring in for the a longer duration, that means the duration is longer means uncertainty is greater. So you have to add some amount of premium to shorter tenor to make sure that longer tenors are preferred. If you are going beyond that longer tenor, on top of that, what you have already added, you have to add some more. So that drives the liquidity premium theory to have this LNT a positive number as the duration increases. So it's very clear to say that the liquidity premium theory is a combination of expectation theory plus segmented market theory. Thereby it explains the all three facts that theory of term structure wanted to recognize. That's the interest rates move together over the time period. Interest rates, when the short-term interest rates are lower, the yield curve takes upward slope. When the short-term interest rates are higher, the yield curve takes the downward slope. That is the expectation hypothesis explanation, 1 and 2 facts. And the third fact, the yield curve always takes a upward sloping curve under normal circumstances. That is the segmented market explanation. As we were talking about, short-term interest rates are lower because demand is very much higher in that set. That is explained by LNT here. So the liquidity premium combines expectation theory and the segmented market theory. So I would keep this preferred habitat explanation, and then how the explanations been extended in analysis for our next discussion, and together with I will start a new area for discussion in the next week's class. So if you have any question before we wind up today, I'll be able to kind of explain it. That would make your life easy with this segment that we are studying today. But this segment is very, very important. Please understand, you look at the risk structure, you try to kind of entangle the risk elements, that is the default risk, and then you looked at the liquidity and tax consideration. But we moved from there to term structure of interest rates, where you made all those elements are identical, liquidity, risk, and tax consideration identical, but you deferred the maturity and tried to explain why the yield curves have different shapes. And this was kind of explained through different theories that takes consideration in today's literature. And this would be able to kind of now apply in the sense that you are looking at all these financial related explanation in different press, different charts, different discussion into your decision making process. But at least some element of understanding you should be able to kind of bring out now. And please go through, read through these details, and it would be much more clearer with kind of application that we would bring into discussion next week before moving into the next class. So if you have any further question, I'm happy to kind of answer here. If not, we will conclude the class today, and we will meet next week. Thank you.